On November 11, 2025, gold has surged to a near 3-week high, signaling deep market anxieties and a growing sense of unease among investors worldwide. Spot gold jumped 0.6%, reaching $4,142.20 an ounce, as investors flocked to tangible assets in search of stability and protection from mounting risks. Gold futures for December also climbed, settling at $4,148.92 an ounce, reinforcing the precious metal's appeal as a safe haven in turbulent times. This broad-based rally shows strong confidence in gold's immediate prospects, especially as it holds above the critical $4,000 mark, a psychological threshold that reassures both seasoned traders and cautious newcomers. Remarkably, this surge comes even as the US dollar strengthens, a scenario that usually pressures gold lower, making this rally all the more significant. The resilience of gold highlights a classic flight to safety, driven by a mix of political drama in Washington, global trade worries, and economic uncertainty that continues to ripple through markets. Inflation fears and concerns about slowing economic growth are adding fuel to the fire, pushing more investors toward gold as a shield against unpredictable shocks. Gold is acting as a barometer for global risk, reflecting a high-pressure system of doubt and volatility that shows no signs of easing. In a world of digital currencies and complex financial instruments, gold remains the ultimate anchor, physical, tangible, and free from counterparty risk, offering a sense of security that digital assets often lack. The recent price action is a stark reminder. When confidence in paper assets falters, investors return to gold, seeking its time-tested reliability. The market's message is clear. In uncertain times, gold is a reliable store of value, trusted across generations and cultures. As volatility rises, gold's luster only grows brighter, drawing in those who seek safety and stability. In this environment, gold's role as a safe haven is more relevant than ever, standing as a beacon of certainty in a world full of financial storms. Gold's rally is set against the backdrop of the longest U.S. government shutdown in history. 41 days of political gridlock. Essential services halted, economic data delayed, and market anxiety soared. Late Monday, the Senate approved a bill to end the shutdown, marking the first real breakthrough after weeks of stalemate. The House is expected to pass the bill, restoring a sense of normalcy and allowing delayed economic reports to be released. This episode is a vivid reminder of how political risk can trigger market volatility and erode confidence. The shutdown wasn't just a domestic issue, it sent shockwaves through global markets. Even as a resolution nears, the scars of this standoff remain, highlighting the fragility of the political process. Investors are reminded that deep divisions can disrupt economic stability. The demand for safe assets like gold is a direct response to these risks. Surprisingly, progress toward ending the shutdown hasn't diminished gold's appeal. Conventional wisdom says a resolution should boost risk appetite and reduce demand for safe havens, but investors remain committed to gold. The shutdown exposed deeper systemic problems: political polarization, fiscal instability, and policy uncertainty. The economic damage is real, with supply chains disrupted and consumer confidence dented. A blackout of official economic data has left investors flying blind, fueling speculation and fear. Gold's value doesn't depend on government reports, making it a natural refuge. The market sees the shutdown as a symptom, not the cause of ongoing fragility. Until long-term stability returns, gold will continue to shine as the preferred haven. The crisis may end, but the underlying risks remain. The shutdown's impact went far beyond politics. It hit the economy hard. Hundreds of thousands of federal workers lost income, slashing consumer spending and hurting the retail sector. Government contractors and small businesses in federal hubs saw revenue dry up overnight. The uncertainty discouraged business investment, stalling productivity and job creation. The shutdown also created a dangerous information void, with key economic reports delayed. Without data, businesses and investors struggled to make informed decisions, and the Federal Reserve was left in the dark. Even as the government reopens, lost wages and suspended projects represent permanent economic losses. Confidence, once shaken, is slow to recover. The episode exposed underestimated political risk, prompting a fundamental repricing in financial markets. Gold's strength is a hedge against not just the shutdown, but the risk of future gridlock. Investors are seeking protection from the possibility of more political disruptions ahead. Gold's role as a safe haven is on full display, shining brightest when uncertainty clouds the financial horizon. As turmoil intensifies, investors instinctively turn to gold, a pattern seen for centuries, from ancient empires to modern markets. Its tangible, physical nature and independence from government promises make it uniquely appealing, offering a sense of security that paper assets often lack. The shutdown is just one factor in a global puzzle of uncertainty, from trade disputes to slowing growth, and even geopolitical tensions that ripple across borders. In this volatile landscape, traditional assets carry more risk, while gold offers no credit or counterparty risk, standing apart as a timeless store of value. The psychological comfort of holding gold is powerful, especially as trust in institutions erodes and headlines fuel anxiety. The shutdown reminded investors that even the most established systems can be fragile, prompting a reassessment of risk and priorities. Gold acts as financial insurance. Its value rises when risks are high, providing a buffer against the unknown. The opportunity cost of holding gold fades as uncertainty grows, making it an increasingly attractive option for preservation of wealth. The sustained demand, even as the shutdown ends, shows investors still see elevated risks and are unwilling to let go of their safe haven. Gold's allure is as much about peace of mind and stability as it is about returns, offering reassurance in turbulent times. In times like these, its safe haven status is unchallenged, standing as a beacon of reliability when all else feels uncertain. Uncertainty over U.S. trade policy adds another layer of risk, casting a long shadow over both domestic and global markets. Every new headline or policy shift sends ripples through the financial world, making it difficult for anyone to predict what comes next. The Supreme Court is now reviewing the Trump administration's use of tariffs under the IEEPA, a case with massive financial stakes and far-reaching implications for international trade relationships. If the tariffs are overturned, the U.S. could owe over $2 trillion in duty repayments, straining the Treasury and potentially impacting government spending and fiscal stability. This legal battle leaves businesses unable to plan for the future, weighing heavily on confidence and investment decisions. Companies are forced to put projects on hold, waiting for clarity that may not come soon. A ruling isn't expected until year's end, ensuring months of uncertainty and prolonging the anxiety that has already gripped the business community. Investors hate uncertainty, and this legal limbo is a perfect recipe for it. Volatility spikes as markets react to every rumor and development, making safe havens more attractive. The potential for a dramatic shift in trade policy drives demand for gold stability, as investors look for assets that can weather unpredictable storms. Trade policy drama shows how legal and geopolitical risks can shake markets, reminding everyone how interconnected the world's economies truly are. When the rules of global commerce are in flux, risk premiums rise, and investors demand greater protection for their capital. Gold thrives in this environment, insulated from court cases and trade negotiations, offering a sense of security that few other assets can match. Its universal value makes it the ideal hedge against systemic uncertainty, trusted across borders and throughout history. As trade tensions persist and headlines continue to unsettle markets, gold's appeal only grows stronger. In times like these, investors are seeking shelter from the storm, turning to gold as a safe harbor amid the chaos. The Federal Reserve's next move is clouded by uncertainty. The shutdown deprived the Fed of crucial economic data, making policy decisions a guessing game. Markets had expected a rate cut in December, but now bets are fading as the outlook grows murkier. If the Fed holds rates steady, it could signal confidence or complacency. If data, once released, shows weakness, the Fed may be forced to act aggressively later. This uncertainty keeps investors on edge and sustains demand for assets outside central bank control. Gold's independence from monetary policy is a key part of its appeal. As long as policy remains unpredictable, gold's stability stands out. Investors value gold's certainty in a world of central bank guesswork. Gold's rally has lifted the entire precious metals complex. Platinum rose 0.7% to $1,587.48 an ounce, reflecting broad-based demand for hard assets. Silver jumped 0.9% to $50.96, outperforming gold and signaling strong investment and industrial demand. The synchronized gains show investors are diversifying within tangible assets. This is more than a gold story. It's a shift toward all forms of hard money. The rally underscores deep distrust of paper assets and renewed appreciation for tangible wealth. As risks mount, all precious metals are shining. Investors are re-evaluating what it means to protect their purchasing power. Recent events highlight the enduring case for gold and tangible assets. The surge in precious metals is a rational response to rising political and economic risk. The shutdown, trade uncertainty, and Fed unpredictability have eroded confidence in the financial system. Gold's value is simple. It's a store of wealth outside the system, immune to central bank devaluation and political instability. The shutdown showed how quickly dysfunction can disrupt markets, reinforcing the need for a buffer. The underlying issues, polarization, trade tensions, slowing growth, are long-term challenges. The demand for gold is part of a larger trend toward portfolio resilience. Allocating to gold isn't about timing. It's about building a portfolio that can weather storms. The world is signaling instability, and gold remains the time-tested anchor. The case for gold is perpetual. Its relevance endures through every crisis.